We will be inviting Ms. Lena Teng, Head of Solutions from MoneyOwl Pte Ltd, one of Singapore's pioneering bionic financial advisory platform, to share with us on this matter. Ms. Lena has 17 years of working experience with the financial industry. She was with the CPF board from 2010 to 2018, developing in-depth knowledge of various aspects of Singapore's national pension scheme. Ms. Lena Teng, please.
Hello, hi, good afternoon everyone, and thank you for joining us on the second day of CPF and Your Retirement EP Forum 2021. My name is Lena and I'm from MoneyOwl, and today I'll be very happy to be your first speaker to share with you more about how you can build a sustainable income stream for your retirement. Now, without further ado, let me begin by first introducing who MoneyOwl is, in case it is new to you. MoneyOwl is a MAS licensed financial advisory firm that will provide a one-stop portal for your financial planning needs ranging from insurance, investment, estate, and retirement planning. MoneyOwl was set up in 2018 as a NTUC social enterprise with the social mission of helping Singaporeans make good financial decisions with their money and also making financial planning services affordable and accessible to everyone. Together with our joint venture with Provident, Singapore's first fee-only Singapore retirement specialist, we have also inherited 2 decades of retirement experience and expertise in the wealth management. At our core, we are planners, and we're very happy to provide comprehensive retirement planning services for our clients to cater for all aspects of their financial health. Specifically, we pride ourselves in our ability to integrate national schemes like CPF into their retirement plans, not just looking at CPF as a source of funds for retirement, but also how your projected CPF Life payouts will be able to form the foundation of your retirement plan. All our advisors are also fully salaried, which means they do not receive any commissions or trailer fees when they recommend solutions and products to our clients. This ensures that any advice that they receive is always conflict-free, objective, and in their best interests. We are also non-tied to any bank, insurer, or VCs, so it also gives us the independence to decide what kind of products and solutions to carry. So in short, MoneyOwl is actually a social enterprise that is run by a group of very passionate individuals who want to help ordinary Singapore working families live fulfilling lives and also make good decisions with their money. All right, so what will we be talking about today? I have structured my presentation according to four threes that you should take note of in order to help you build a sustainable retirement income. And by sustainable, what I mean here is that not just looking at something that is sufficient for your desired retirement lifestyle, but also something that would be an income stream that would also be able to withstand the shocks that you might face during the 20 to 30 years of the longest holiday of your life. To achieve this, we need to know what are the essentials that you need to provide for, as well as the key risks that you need to look out for. By knowing these 2 things, we'll then put together a retirement plan using a simple 3-step process. And lastly, I will cover briefly what are the 3 ways that you can draw down an income from your investments. So it is not possible for us to actually talk about retirement in Singapore without making reference to the CPF's role in it. After all, the CPF is our national social security system that was designed to help us meet the 3 must-haves that we need to have in retirement. The first is a fully paid out house, so that we don't have to worry about where we will need to stay or whether so that we can actually age in place and not have to worry about where we will stay during our golden years. Through the CPF contributions that you make into your CPF ordinary account from the first day that you started working, most Singaporeans are actually able to own their first home. And it is also no surprising that Singapore has actually one of the highest home ownership rates in the world at about 90%. We also want to make sure that your home will be fully paid up off before you enter retirement, so you don't have to worry about debts. So together, the other thing to take note of is that with a property, you will be able to also monetize this for an income stream should you need to do so during your retirement. The second thing that you need to take note of, or a second must-have that we should need to take care of, is medical insurance to pay for our hospital bills, even as we grow older and our body needs so-called greater maintenance. So thanks to MediShield Life, which all of us will have, we are able to afford many of the large hospital bills in in highly subsidized wards in government hospitals. According to MOH, with the recent revisions to the MediShield Life claim limits, we will now be able to cover at least 90% of your hospital bills in such wards. However, if you have needs or aspirations to stay in higher class wards or the option to seek treatment in private hospitals, you may want to also supplement your MediShield Life with integrated shield plans that are offered by private insurers. The premiums for MediShield Life, together with that of your private insurer, can be paid through your MediSave savings. Lastly, we also want to make sure that we have an income stream to pay for our living expenses. And this income stream, as much as possible, should be able to last you for as long as you live. With CPF Life, we don't have to worry about that because CPF Life gives you a payout from the age of 65 years old for as long as you live. In addition, for as long as you live, and the amount of money that you can actually get from your CPF Life payouts is actually dependent on how much savings that you have already set aside and accumulated over your working years. So for some of you, you may feel that perhaps your CPF Life payouts may be insufficient for you and you would like to have more, in which case you can also look at how you can draw down an additional income stream using other cash investments that you have. So as you can see from here, CPF itself plays a very important and fundamental role in helping you achieve the 3 must-haves in your retirement. Next, I will look at talking about the 3 key risks that are faced by a retiree so that your retirement plan can withstand any shocks that may come your way. We need to know what these key risks are and how you can go about mitigating them. For the purpose of today's presentation, I'll be focusing on 3 of them, which is longevity, healthcare, and investing risks. So, when it comes to longevity, it should be no surprise to you that in addition to having one of the highest home ownership rates in the world, Singapore also has one of the longest life expectancy in the world. According to the statistics, men are likely to live, the average life expectancy for men is up to 81 years old, and that for women is 86 years old. What's more, the probability of outliving this national average actually increases as you grow older. According to statistics from the Department of Statistics, this table that I have here, what we can see is that if you are 55 years old today, the probability of you living beyond 85 years old is actually 1 in 2, and you have a 1 in 3 chance of living beyond 90 years old. In fact, these percentages also increase the older you are. So what does this mean is that this mean is that you will need to provide for a income that can actually cover you for as long as you live. So while living up to 90 years old could be a blessing for all of us, we want to make sure that it remains a blessing for us by having sufficient retirement savings that can last us that long. What's more, for ladies who are listening in as well, you will also need to save more as you are likely to live longer than your male counterparts. So recently, I was actually working with a client as well who wanted to plan for his retirement plan up to the age of 83 years old. His thinking is that he only needed to plan up to the national average. After all, then he doesn't have to actually set aside so much. However, I told him that how certain he was in terms of which side of the national average is he going to be on. So rather than having to make a guess on that, isn't it better to make sure that you're actively mitigating this risk when you plan for your retirement? So while we may be living longer, and most of us will probably live into our good 80 years old, are we actually living more healthily? According to MOH, the healthy life expectancy at birth for Singaporeans is actually 73.9 years. This number actually tells us the number of years that we are expected to live in good health. So if my average life expectancy is maybe until 86 years old, and I'm expected to live 74 of them in good health, this tells me that at least 10 years will be lived in poor health, either due to illness or injuries. So And in fact, according to MOH, they expect that 1 in 2 healthy Singaporeans aged 65 could become severely disabled in their lifetime. And of this, 3 in 10 could remain in disability for 10 or more years. So to cater for this risk, right, we need to factor additional costs for healthcare and caregiving expenses, as well as its related insurances when it comes to how much we need to set aside, for our retirement income. A long-term care insurance, like CareShield Life, would be a very affordable way to help you secure a monthly payout for life in the event of severe disability to take care of your caregiving expenses. CareShield Life will be made available to all Singaporeans, regardless of age, by the end of this year. So another concern that you may have with regards to healthcare risk is that of medical inflation. According to MOH, the cost of healthcare has increased more than 50% over the last 20 years, or an inflation of about 2.3% per year. This is actually higher than the headline inflation. So even with MediShield, which forms as the foundation of our healthcare planning as well, and is able to help us pay for many of our basic expenses, we need to also be prepared that in the future, we will have to pay higher premiums as well in order to counter medical inflation. In addition to that, we also need to cater for higher cash outlays in order to pay for treatments or alternative medicines that will not be covered by MediShield Life or your integrated shield plan. If you currently have an integrated shield plan and you're thinking of keeping this together with you throughout your retirement years, this table should be of interest to you as well. This table is actually showing you the premiums of an integrated shield plan that covers a private hospitalization. Though the premiums look very affordable when you are young, as you grow older, you will notice that the premiums actually increase exponentially. For example, looking at somebody who is 75 years old today, the cash outlay that he can expect to pay for this insurance is actually about $2,600 per year after deducting the monies from his MediSave. So this $2,600 per year, or about $200 per month, is an amount that you also need to factor into your retirement planning. However, if you feel, or alternatively, if you feel that this is something that could be potentially unaffordable for you as you grow older, you can always look to review your insurance planning by either downgrading your IP plan to a lower lower tier, or even dropping it entirely. Don't forget, even if you drop your IP plan, your MediShield Life will still be there to provide you with a basic healthcare coverage. Now, thirdly, we will talk about for those of you who may still be investing in your retirement in order to stretch your retirement savings or to counter inflation. This will be of interest to you. This third risk is actually what we call the sequence of returns risk, and and specific to them, this refers to the order in which the returns occur during your retirement years. Let me use an example to illustrate what I mean by this risk. So we have a tale of two investors, Investor A and Investor B, both invested $100,000 into a portfolio over 25 years that in returns an average of 9% per annum. The only difference between these two persons, right, is that for Investor A, he actually suffered a downturn early on when he started investing, whereas for portfolio B or Investor B, he actually experienced the downturn only towards the tail end of his investments. So regardless of whether how the markets have moved up and down, both of these portfolios actually return an average of 9% per annum. So based on this, how do you think their portfolio performed at the end of the 25-year period? So maybe you like to think about it, 1 second, 2 seconds. So you may be surprised to learn that actually, after 25 years, both investors actually ended up with the same portfolio of $690,000. So this actually tells us that the order in which the returns occur during your accumulation years actually doesn't really matter. In fact, rather than focusing on the maximization of your returns, what you really should be concerned with is actually the consistency and the reliability of that long-term returns, so that you will be able to accumulate your wealth accordingly. Now, let's take a different look. What happens to Investor A and Investor B when they retire? Assuming they choose to remain in the very same portfolio with the same sequence of returns, but instead now they choose to withdraw 5% from their starting portfolio every year and adjust it for inflation, what would it look like right now? You will see a very different story. In fact, Investor A actually runs out of money after 18 years, while Investor B's portfolio grew to a whopping $2.6 million after 25 years. So why is this so? This is because for Investor A, he actually experiences the market downturn early on, coupled with annual withdrawals to finance his retirement. So in other words, he is in addition to his portfolio actually suffering a loss experiencing a temporary downturn due to the market conditions, he is also drawing down on his capital and realizing his losses. So even when the market picks up later, he is unable to recoup his losses, and thus this income stream, his retirement savings, is not able to last him through his entire retirement period. On the other hand, Investor B started off when the market is actually going up. So and actually he only needs to draw down on his investment gains during this period of time without even having to touch his capital. So his capital, which remains invested in the markets, continue to grow and to a very huge amount, so that even when he suffers the market downturn towards the tail end of his retirement period, it doesn't matter because it is able to withstand this shock. So what this tells us is that the sequence of returns actually matters in withdrawal. So as you can see, when it comes to investing for income, the focus is no longer about chasing the highest returns, but rather focusing on how you can actually use a systematic withdrawal strategy in order to help you get a reliable income that can last you for as long as you live, and help you also mitigate this sequence of returns risk that is specific if you're investing in retirement. All right, so now that we know what are the 3 things that we need to provide for, as well as the risks that we need to look out for, let's take a look at how to put this all together in a plan. Most people will do it this way. I start by thinking about how much I need for my retirement. Supposedly, I need about $4,000 per month. This translates to about $48,000 per year. Then the next question I need to ask myself is that how long do I need to provide this for? Supposedly 20 years. So if I take $48,000 and I multiply it by 20 years, it means that I need to have a retirement nest egg of at least about $1 million by the time I turn whichever age I want to retire. So working backwards then, I will need to then figure out how much I will have to save and invest today in order to help me accumulate to that lump sum by the time of my retirement age. And sometimes doing this calculation can really give you a scare when you realize how much you actually need to save and invest today to help you reach these goals. However, there are some problems with this way of planning. With inflation, chances are that you will actually need to draw down more than $4,000 per month from your retirement savings in order to help you achieve the same level of standard of living year after year. This means withdrawing more than just $4,000 from your savings, and it also means that which means that you will deplete your savings even faster. The second assumption here is that it assumes that you will pass away after 20 years. But what if you don't? How do you then continue to sustain your retirement income? And one of the reasons why the amount that you need to save and invest today looks so horrendously big is actually because it doesn't factor how much your CPF Life payouts would already give you based on your current CPF savings. And there's one very critical point about this way of planning is that it actually does not consider your current desired your current desired lifestyle today. Okay, a financial plan is only useful if it helps you to achieve your life goals today and also in the future, because life starts today, not 20 years later. All right, so how should we go about approaching retirement planning instead? Here are 3 simple ways in which you can follow. The first thing you can do is to estimate your retirement income by starting with what you already have, rather than plucking a number out from the sky and thinking about that is the number that you need to aim for. Clients who have gone through a retirement planning session with us actually find that this is a very liberating process because they realize that after factoring CPF Life payouts into their retirement income stream, as well as how they can use a systematic retirement withdrawal strategy to draw down an income from their investments that can last them a long time, they find that they actually are in a pretty okay situation and they don't have to feel very gloomy or dreary about their retirement. The second step is to estimate your retirement income needs using available and plan it within your available resources that you have derived from step 1. The other thing to take note of is that you may want to derive your estimates based on existing household expenditure surveys that will give you a more realistic view of how much people are actually spending in retirement. And step 3, you can build a sustainable retirement income by employing different strategies to help you build a sustainable income stream that can mitigate longevity, investing, and your healthcare risk. So let's go through each of the steps right now. So at the foundation of the retirement planning, as you grow your wealth over the years, you may have actually accumulated many different assets. And one of the problems or one of the headaches that we see that many of our clients who come to us who are in a pre-retiree age is they don't know how to consolidate all their assets. They may have a bit of investments here and a bit of investments there, some insurance policies, and they wonder how they can put all these things together into a systematic plan that is easy for them to manage. So if you find that you are in this kind of situation or working towards this kind of situation, you may want to work with a financial advisor to help you sort through these assets by grouping them or making sense of them according to their relative volatility, how they're going to contribute to your retirement lifestyle, as well as the ease of management. Okay, at the foundation of this, how you want to look at your assets would be your CPF Life that pays out a stream of income to all members from the age of 65 years old. Okay, then subsequently, after setting aside the required retirement sum into your retirement account for your CPF Life, if you have any excess balances in your CPF ordinary and special account, these could be used to finance your retirement before turning 65 years old, or you could also leave the savings behind to earn the good risk-free interest and let these accounts function as your emergency funds account instead. You may also have bought insurance plans over the years, and these can also now be streamed out as a stream of monthly income for yourself over a fixed period of time or as long as you live. Lastly, you may also have cash savings as well as fixed deposits. So all these instruments can be depended on to give you a steady stream of income to match your basic and fixed expenses. At the top level here, you will have instruments that can give you potentially higher returns as they involve taking on market risks. These are investment instruments that you may hold on to with your cash. And they could include rental from your investment property, interest and dividends from your stocks, your bonds or your unit trust, as well as cash that you may be getting from your children, continued work, or even a business that you own. These cash flow from these instruments are likely to be less stable than those in green, in turquoise or green below, because you're taking market risk with them, and they also usually require a bit more effort for you to manage. If you have multiple investments all over the place, it will be timely for you to consider consolidating them. I recall having a meeting or speaking to a retiree who was about 70 years old back when I was in CPF board. He told me that he wanted to liquidate all his equity investments and put them all into CPF Life. And this was actually very surprising to me, especially when I found out that he is a remisier, and which means that he has spent his entire professional life buying and trading stocks and shares on behalf of his clients. Surely he would have no problems managing his own equity investments. But he told me that he didn't want to do that anymore into his golden years when he's in his 70s and probably into his 80s, because he just wants a very easy way to manage his money and have a fast, free way of drawing down an income. So in which case, he found that CPF Life was very suitable for him. Okay. So I think this has also helped me to recognize that when it comes to planning for your retirement income, it's not just about chasing for the highest returns, but it's also making sure that it's something that is easy for you to manage so that you don't have to keep monitoring it into your golden years. Now, putting aside all these other assets, let's take a look at just CPF Life. Okay, so would it actually be sufficient for your retirement itself? So based on the CPF Life standard plan payouts for a member who turns 55 years old this year, if he's able to set aside the basic retirement sum, which is $93,000, he will be able to receive a monthly payout of about $800 per month. If he's able to set aside the full retirement sum, which is 2 times more, he will be able to get about $1,400 to $1,500 per month. And if he's able to set aside the enhanced retirement sum today, then his monthly payout from his CPF Life would grow to more than $2,000 per month. Couple this with his spouse, assuming the spouse is working or he's able to top up for the spouse up to the enhanced retirement sum. Between the two of them, they would be able to enjoy a lifelong income that is stable and almost guaranteed for the next of at least $4,000 per month. Although this will not afford you a super luxurious lifestyle, it is certainly more than comfortable for today's retiree. Why do I say that? Because if you look at the household expenditure survey statistics in 2007 and 2018, they found that the average monthly household expenditure for a retiree household is on the average is about $1,900 per month, and for a single person is about $1,100 per month. Using these numbers as a reference point, you realize that actually, depending on your CPF alone, should be actually sufficient. So what I did next was to then pull out the monthly expenditure per member of a retiree household and also scale it down further to look at what are the types of goods and services that these people spend on. So it's not surprising to see that for an average retiree household, most of the monies that are actually spent on food, housing and utilities, healthcare needs, and miscellaneous goods and services. So in this case, miscellaneous goods and services refers to personal care, social support, such as employing a helper or caretaker, and also for your insurance. This is how much an average retiree household actually spends today. So if you are planning for your retirement in, say, 10 to 20 years' time, you probably will need to inflate this by maybe 2 to 3% to cater for inflation, in which case it's looking at about $2,000 per month for your retirement needs. However, I'm pretty sure that some of the attendees today aspire to spend more than the average. So what I've done here is that I've also pulled out the numbers for those who are spending in the 5th quintile of the among the retiree households. In other words, the top 20% of the population. The monthly expenditure in this case, you can see here, has increased by 2.5 times to about $2,800 per month. And if we look further into the breakdowns of the different categories, the main differences we can see is actually in the area of transport, food serving services, as well as miscellaneous. So putting this together gives me an idea that a retiree household that falls within this category is likely to own a car, likely to go to eat at restaurants more often, and also probably have a domestic helper at home taking care of their household chores. So if you find that this is the kind of retirement lifestyle that you're aiming for, together with being able to travel very, very often, according to the poll earlier, then you may want to provide slightly more for some of this, slightly more than the national average. In which case, perhaps beyond your CPF Life, you will then need to set aside or plan for an additional stream of retirement income. So now that we have put all these things together, now that we know where all the different sources of income will come from and an estimate of how much you will need to spend realistically, it is time to put all of them together. Okay, the first thing you should do is to build a safe retirement income floor that is sufficient to help you meet your basic and fixed expenses, such as your food, your utilities, your healthcare needs, and possibly for transport. You can source this retirement income using your CPF Life from the age of 65 years old, or before 65 years old, any excess balances that you may have in your CPF Ordinary and Special account. Also, payouts from your retirement income insurance plans can also fall into this category, as the payouts are expected to be stable, if not guaranteed. As CPF Life provides you a payout for life, this is actually really the best solution that you can get to mitigate against longevity risk. You can also build a second stream of income from your various investments to help you fund your discretionary expenses, such as your recreation needs, like traveling, food serving, going to restaurants to eat often, or even for you to continue owning your car. Since it is possible to vary the amount that you spend on these items on a month-to-month basis, you can actually choose to defer some of this expenditure when there is an investment, when the markets are not doing so well, so that you don't have to touch your investments. So this stream of income would then enable you to actually capture higher market returns to help you stretch your savings longer and also to counter inflation. So it's important to not just put all your assets into a very, very safe basket of instruments, but also to couple that with a bit into the markets so that you'll be able to mitigate some of this risk that I have mentioned. Okay, lastly, if you are looking to build an income stream from your investments, you will need a systematic withdrawal strategy to ensure that your income is sustainable for life. There are several ways you can achieve this, but today I will just highlight 3 of the more common ones. The first is through the use of an annuity plan like CPF Life and your insurance retirement income plans, which I've already mentioned before. The benefit of doing so is that you have already transferred the risk of outliving your savings to CPF board or the insurance company. The downside, though, is that you will lose control or flexibility over these savings because this either the CPF board or the insurance company will have to pool all these assets together to ensure that to risk pool all these assets together with other people to achieve the outcome of lifelong payouts. And this would usually mean that you'll not be able to bequeath these assets to your loved ones if that is something that is important to you. Now, for those of you who have already maxed out your CPF Life payouts through the various top-up schemes that are available, or you would prefer to retain the flexibility in those savings, you can opt to use the other 2 methods, which I'll be sharing with you. The first is a fixed spending strategy where you will withdraw a fixed percentage of your starting portfolio value adjusted for inflation annually. So based on the one way to do this is using the 4% withdrawal rule, which that William Bengen came up with. Okay, he found that you can actually withdraw 4% every year from your starting portfolio, adjusted annually for inflation, to last for 30 years or more, provided that you actually invest in a balanced portfolio. And it is so even after factoring the sequence of returns risk, which I mentioned to you earlier. The benefit of this strategy is that you can get certainty in the amount of payouts that you get because it is fixed. However, it does have its drawback. There is a chance of running out of money if the income stream is meant to be stretched out over a very long period of time, or you may end up leaving too much of a bequest behind, like the investor B that I illustrated earlier. The third strategy that we have is what I call the variable spending strategy. In this case, you actually withdraw a variable amount based on the percentage of your current portfolio every single year, and you can also choose to adjust this amount based on your remaining life expectancy so that you do not end up leaving too much behind of a bequest. The main downside from this is that is the variability of the income, but you actually trade it off by being able to sustain your payout over a long period of time without having to leave behind too large a bequest. How you can achieve this is by investing into a fund that pays you a stable dividend rate, such as MoneyOwl's Wise Income Fund. So as you can see, when it comes to planning for a sustainable retirement income stream, it is very important to have ongoing advice as environments can change, markets can change, your desired retirement lifestyle can also change, and this is something that goes beyond selecting an investment product. Advice is required to help you structure a retirement flow that lasts you and mitigates all these risks. So in summary, build a sustainable retirement income that helps you achieve the 3 must-haves in retirement and also mitigating the risks that retirees face. Start with what you have first, as much as possible. Optimize your CPF for your retirement, then layer on with cash investments if you need more. Use a withdrawal strategy or a combination of the withdrawal strategies that I've mentioned to you that best suits your retirement lifestyle. So lastly, if you'd like to know more about what I have shared, or you would like to also build your own retirement income plan for yourself using the methods that I have mentioned, feel free to check out our website, our comprehensive financial planning services, to learn more, or you can always drop us an email at enquiries@moneyowl.com.sg. So with that, I thank you all for listening in and wish you all the best in your financial future. Thank you.